Using options for consistent returns with Don Kaufman. This is a TheoTrade presentation. We throw up a risk disclosure. We are not financial advisors nor a broker-dealer. My previous life in the trading world was at the brokerage world, so we always throw that in there. I'm no longer in the brokerage world. No soliciting, no recording, no photography, no feeding the monkeys. With that copyright disclaimer, this is ours. This is not yours. However, we make a recording available. The real reason I throw this up here, this is how to get a hold of us after this evening. We answer emails. We want you to know that right up front. When I say we answer emails, if you need to get a hold of me or anyone here at TheoTrade after this evening, whether it's Tony, whether it's Matt, whether it's Brandon, myself, and Jeff Bierman, Corey, support at TheoTrade.com. Just put our name in the header and the email will effectively go to us. Next, a little bit about me. I'm a co-founder here of TheoTrade. I started trading in the late 90s. I kind of come from a family of traders. I had family trading in Chicago. I was about 3 weeks out of college. I was invited into, again, a trading firm. About 18 months after that, I was invited into a startup brokerage firm. That brokerage firm became basically the largest in the options arena. By 2007, we had gone literally from 12 individuals to, by 2007, I think we had 700 plus. Took the company public. Were eventually acquired by TD Ameritrade. I actually stayed on. The acquisition by TD Ameritrade was in 2009. I stayed on all the way till 2015. 2015, I finally hung it up after, about a 15-year run at both thinkorswim and TD Ameritrade. But the last 5 years of my career, I had run the education division of TD Ameritrade and their 7 million clients before, of course, several of us actually left, and we founded TheoTrade. So a little bit of background on me. Done a couple of CNBC tours over the years. This is just the most memorable. It's Don versus the Shark, Mr. Wonderful himself. I ruin it for everybody. He could not be a nicer guy, all right? He's a really nice guy. I got to talk to him for a good 30, 40 minutes prior to this particular interview. But by the way, I was the short in Apple at the time. It was actually a really good time to be short Apple, too. A little bit about TheoTrade. We specialize in education for stocks, options, and futures. Everybody on our crew, a moment ago I was talking about some of the instructors in the crew, but all of us have a minimum of 15 years of experience, a few of us with a couple of decades. We're here to help you mitigate the risks of the market, and you're going to learn a skill set that is going to last you a lifetime, especially this evening. What I'm going to talk about this evening, this is absolutely kind of like the mantra here. Here are some of the TheoTrade instructors. This is another aspect that's important to me before we get off and running. TheoTrade is not just, myself, Don Kaufman. We have Jeff Bierman. He's the former chief market technician for TD Ameritrade. If you've ever been on the thinkorswim charts, Jeff Bierman helped put most of the studies on there. Next, Matt Williamson. He's our market neutral. He's our premium selling options strategist. If you're familiar with selling options premium, that's the guy. Corey Rosenblum. He's our senior strategist, kind of our resident swing trader. Then we have Brandon Chapman. Brandon also worked for TD Ameritrade, CMT, and he is phenomenal in macroeconomics. We're not like a one-trick pony. We don't just look at charts over here. We've got market technicians. We got fundamentals. This is this is Brandon. He's kind of our version of like a Ben Bernanke here at TheoTrade. Then we have Steve Miller, 43-year veteran options futures trader, also gets heavily into psychology of the trader. Last but definitely not least, we have an intraday specialist. That's Tony Rago. Again, tonight, Tony is live to answer questions. Brandon is there. Corey is there. Matt is there. Jeff is there. If you've got questions, those are the instructors that are going to be answering them. I'm also reading the questions live on here this evening. And people are, why do I bother coming live? I'll tell you why you bother coming live. Because you actually can interact with these instructors, and it's worth your time. It's worthwhile. All right. What you're going to learn in the presentation. Number one, how you can build a trade that is going to be successful over many occurrences. So you want to avoid what I call one-hit wonders, and you really want to avoid the types of trades that can cause some very significant losses. All right. We're also going to display how to take minimal risk produce very consistent 55% plus returns surrounding high probability movements, any stock, any ETF or index, okay? How you can take a high probability directional position, okay? Whether you're a long-term investor, if you're a swing trader, intraday trader. We're also going to talk about risk reward, growing a small account. Everything I talk about tonight can be done in a retirement account, or, some people, if you have this problem, a large account, it's fine, okay? This is a very, all right, versatile strategy that I'm going to talk about tonight, and how you can trade without having to continually monitor positions. We've already had a couple of people ask that question in there. Somebody was chatting in, I'm from Hawaii, I can't necessarily watch this, or, there was an Aussie in here I was chatting with earlier too. Brisbane, Australia, nice. This is very much a set it and forget it strategy. It doesn't have to be monitored throughout the course of the day, and I'll talk a little bit about that. All right, let's get right into it. I want to start with this. Risk and success. So I think this is always a viable place to start really any discussion about trading, but one aspect I think very often that's overlooked. People tune in tonight and they're like, all right, let's make me some money. Yeah, well, to make some money, you got to learn how to handle your risk. Now, I'm speaking to those for just a moment that have some experience in the marketplace. And you'll know this, but how you handle your risk is directly correlated to your success in the markets. If you have too much risk, and risk is such an overlooked aspect, but if you have too much risk, you're going to panic and you're going to close positions continuously at the worst possible time. But at least you're consistent with your panic. What I'm actually talking about is this is where people, they have themselves in a little bit too deep. They put in stop orders, right? You literally get stopped out at the worst possible time. How many people have ever been through that before? And I love this as your, this is what they call puking up your position. Look, he's at least a Mac user. But what I've learned, 15 years in the brokerage industry, I have looked literally at hundreds of thousands of accounts. I've seen what works and what doesn't. Just to give you guys a little bit of a little background, about 5 years of TD Ameritrade, I was running education for over 7 million clients. And what we used to do is we used to study client accounts, which is kind of enthralling. I mean, you're studying the accounts and you're looking at, and we had, by the way, we had an entire division, okay, that was like actuaries. They called them the nerdery, that would literally help us study accounts. We could ask them questions in any way, shape, or form. That we didn't look at like, individual accounts. We didn't go in there and we're like, hey, what's Tom doing in the account today? That's not how it works. You're looking at this on like a global level. You're trying to figure out who's doing what option strategies, what's working, what's not. And the irony of that, what doesn't work just gets repeated over and over again. And today, we're actually going to discuss the opposing side of that, okay? It's consistency. It's what has worked, what is working, and what will consistently work. And again, what I've learned comes not just from me, okay? Not just my, 21 years of market experience, not just the instructors here at TheoTrade. It comes, okay, from in-depth analysis and quantitative analysis of over 7 million brokerage accounts. Let me start with this. Theory, trade, logic. First of all, that's what TheoTrade actually means. And people always ask, what's the name TheoTrade? It means theory, trade, logic. Probabilities are laws in the market. One trade, good or bad, does not define you as a trader. One trade can never knock you out, right? Remember that. It has a lot to do with allocation. Trading goes beyond one trade or one idea. It's about, hundreds or even thousands of occurrences and having the right logic over time. Remember, this has got to be a lifelong skill that you're going to learn. No one learns this stuff overnight. Okay, even if you have experience, people come in here, they're like, I've been doing this for 15 years. Good. Okay, you're going to learn a lot then tonight. So go easy on yourself because we're going to kind of rebuild you in terms of this business. If you're brand new to trading, fantastic. Who here is brand new, never really placed a trade before? Come on, it's good. Right? Like, I'm serious. Like, who here is brand new? Because I like it. You're starting with a clean slate. You don't have to unlearn anything, right? Those of you that have some experience, you kind of have to, how do I say this nicely? You got to get rid of the not so good habits, right? So here's the principles and here's how we approach building a trade, building any trade. Like, as I said, the strategy I'm talking tonight, this is like the mantra, if you will, of what we do here at TheoTrade. I'm going to start with this. This is principles. This is what we would look at before entering into any trade. It's what's most important. Trade logic. Most people are like, what is trade logic? What? Trade logic is, okay, everything from strategy to your approach to the marketplace, right? So what are you doing, okay, to get into a particular trade? Like, you might say, like, I am bullish on Apple. I'm bullish on Apple. That's wonderful. But directional bias, that's what we call tertiary. That's the third, the third one down on the list. Bullish on Apple, okay, it's not even secondary. It's like that's in the back burner right now. What's your trade logic? How are you going to get bullish on Apple? How much capital are you going to allocate to this? Because I promise you this, if you don't have good trade logic, if you're not entering into the position properly, okay, bias means nothing. Bias means absolutely nothing. And capital allocation is the underdog. Why is capital allocation so important? Because if you're too big, you're dead. Because you will get yourself in trouble. And the second you're in trouble, you'll panic and you'll barf up your position. Am I right? Because this is where people have to unlearn. Trade logic is the absolute pinnacle of this, and you're going to learn some of that tonight. Think about trade logic. We'll worry about directional bias. We'll worry about capital allocation later. Trade logic, trade logic, right? Here, trade logic. Place strategy and trade logic first. The vast amount of people involved in the markets, they're infatuated with market direction. I mean, if you think about it, the entire industry, it's CNBC and Bloomberg and everything that you're bombarded with, okay? I'm bullish, I'm bearish, I'm so bullish that I'm bearish. I love when they get an analyst on there, one bullish, one bearish, okay? I just say throw them in a ring, let them go at each other. Everything is about predicting the future. How's that worked? How has predicting the future worked historically? Oh, people can't see anything. They can't even figure out an election these days, and they have election results coming out prior to. The right strategy, though, coupled with established entry and exit criteria, you don't need to be right in picking direction in a stock or the markets in order to be profitable. Remember that, okay? Because I throw fun at the whole prediction thing because it's just that. What do you think is going to happen? I don't know. Next, capital allocation. How and where you allocate capital should be strongly considered as a viable portion of your trading methodology. Capital allocation actually takes precedence over being right, because I promise you again, it ain't going to matter if you're right or wrong, because I promise this to you. If you are over allocated, now I want to know how many people have done this. Over allocated. What does that mean? It means you're too big. Have you ever been over allocated? You panic. You get out only to see the position go the right way right after, right? I'm just basically going through some basics in the market here to get you, again, and kind of rebuild you to pay attention to trade logic. Nobody here's ever done that before? Over allocation. Get a little nervous. Are you nervous? I'm feeling a little nervous. Been there, done that. Directional bias. I'm not anti-charts, okay? In fact, I mean, if you look at the makeup of TheoTrade, when I say I'm not anti-charts, Corey Rosenblum, excellent market technician, right? Jeff Bierman, he's a charting extravaganza unto himself, all right? We can go Brandon Chapman, I mean, CMT, I can go on and on. The instructors here, Slim Miller, they're into charts. But we still recognize where you think a stock might go. The market doesn't always agree with your sentiments, right? Being right directionally cannot define us as investors or traders, for we may not be right often enough, right? Last but not least, duration over direction. How and where you allocate capital can define not only losses, it can actually be the defining factor in your overall success or failure in the markets. Our war cry is often duration over direction. You need to be capable of sustaining trades long enough to be profitable. Now, I'm going to show you precisely what that means here momentarily. Before I do, okay, one other thought, and then we're going to dive into the strategy. You want to be right or you want to be happy? Because my wife, again, frequently reminds me of that famous phrase, right? Do you want to be right or do you want to be happy? I have not applied this to my marriage, but the logic seems to work beautifully in trading, right? I've always taken that stance You do not have to be right, okay, to necessarily make money in this business. Okay? Why? Experience and watching order flow for decades, they've taught us invaluable lessons. All right, think about this. Have you ever been stopped out of a trade or bailed out of a position only to see the markets turn around shortly thereafter? I was kind of probing at that a little bit just a few minutes ago. And this is where most of the people are like, oh, yeah, that happens. That happens to me. It hurts. Okay? And I'm telling you, this is about, do you want to be right or you want to be happy? How can you overcome this? Well, today, I'm going to introduce you to one. It's a real world strategy that you can start using and employing this logic tomorrow, right? This is about core strategy and trade logic. And it's about using real techniques that most of you, okay, should be employing right here, right now. But first, risk versus reward. So when we first learn about markets and trading, we're often exposed to the ideas of risk versus reward, right? And again, this is kind of walking you into this idea of trade logic, right? Risk one to make two. That's a very common and very strategic entrance to the marketplace. I mean, it's logical, right? You go, every time I am wrong, I lose one. Every time I'm right, I make two. I like it. But have you ever looked at the probability of success of that idea? Have you? Okay? Because most people don't know how to break it down. Well, I'm going to show you exactly how to break it down. Ready? Let's do this. Okay? Let's debunk risk versus reward. Let's take a look at the following example. So we're going to go out and we're going to proposition is a little position over here. With that, let's go out and let's buy a stock. I'm just going to make this a $30 stock, all right? In my example, it's a $30 stock. We're going to go out there and set a stop at 29, right? So you go out and you've bought this stock at 30. Stop is set at 29. So what's your risk in here? It's $1, okay? That's the little risk right there. Then the target price to the upside, we'll call this the target, is set at 32. Right? What can you make? $2. So that's the profitability aspect of it. Here we go. This is just that typical, that quintessential risk one to be able to make two. This is how people set up all these different trades. They do this in stocks, they do it in options, they do it in futures. How many people have ever done that before? Come on. These are not rhetorical questions. Get in here, people. Okay? How many people have ever set up something similar to this before? Anyone? Oh, I'm going to pause now. I'm going to pause until every one of almost 1,000 people answers. Oh, I like this. Somebody actually came in and goes, I've never put on a stop. You've never put on a stop, but did you employ that logic? I'm going to risk one and I'm going to get myself out over here. Okay? I'm going to get myself out. By the way, somebody's like, no, because I've never traded before. Okay, you're okay then. Me and you, we're on the same page over here. That's good. So this risk one to make two. All right? But let's actually break it down. Probabilities in your trading. So let me ask you something. What is more likely? So we put this strategy together all the time, right? Risk $1 to be able to make two, risk $1 to be able to make two. But did you ever step back from the strategy for a second? And you have to think to yourself, here's this stock, and the stock is trading right smack at 30. Okay. Now a stock oscillates up and down and up and down and up and down. From a probability standpoint, what is more likely? The stock going up $2 or down $1? Nobody ever steps back and goes, he does make a viable point. Let's assume that you don't know anything about direction, because you don't, right? Remember we talked about predicting the future a little bit ago? My crystal ball says, I'll tell you what my crystal ball says. My crystal ball says you're way more likely to move $1 than $2 in a normal market fluctuation. You're going to hit $1 before $2. So the probability of you getting stopped out is substantially higher than hitting your target price. Huh? Yes. Okay, think about that and go, well, is the stock in an uptrend? By the way, that doesn't matter. I don't care if the stock's in an uptrend or a downtrend, because I'll tell you what, normal oscillation of the stock is still going to give you, all right, what? over 100 or 1,000 occurrences, you're going to get stopped out more often than you're going to hit your target price. Plain and simple. There's no if, in, or but about it. Now, we're going to actually put probabilities, definitive probabilities to this. You ready? Breathe deeply. Options or probabilities. I said the O word. Okay, listen. We're going to talk a little about options. It's okay to talk about options. Maybe you never traded options. Maybe you've never looked at options. Maybe you've never looked at or wanted to trade options. But I'm going to make the argument of this. Even if you do not want to trade options in today's marketplace, if you do not have some understanding that options are probabilities, okay, you're putting yourself at a massive, massive disadvantage. Okay, I'm not here to pitch to you like, hey, you need to trade options. You need to listen, okay, there's millions of people trading options today. I'm just telling you, if you don't look at them, you're missing the boat. That boat is just sailing right by you. Okay? Options can help us in determining the viability and practicality of any given trading strategy. How? Why? Let's look at what the probabilities are in the aforementioned risk 1 to make 2 trading setup. And let's see if it's viable over the duration. Now, okay, people, I'm about to show a slide. The next slide is scary. It's deep. I'm going to take you through it a little slowly, okay? Because the most important thing is not to understand options. The most important thing is to understand that probabilities are in play here. Ready? Okay, it's a big, scary slide. By the way, disclaimer, the screenshot was actually taken yesterday. The stock has moved minimally, but yeah, it's fine, okay? It's good, eh? This is a stock called Cisco. Right? Whether you know it or not, something that you're doing right now is probably running over Cisco. How do I know that? Because you're on the internet. The stock is trading, by the way, I took the screenshot right smack at 57. Okay. By the way, the trading application we're using over here is thinkorswim. It's okay if you don't have thinkorswim. That's fine. I can show you how to do this on any trading application. But the stock is trading right at 57. So I went out in the options world and I looked at what did the options 18 days from right now, like they're giving you 18 days in the future, what did they say about what we term probability of touch? Now, all of a sudden we're talking about stock and then we're talking about options in 18 days. They're like, okay, relax. You know what probability of touching is? Probability of touching says, what's the probability? Here's all I want to know. What's the probability that any time in the next 18 days, the stock could hit, for example, 59 or 57. Did you know that options can answer that question? It doesn't matter if you trade options or not, but they can answer the question, what's the probability of touching or exceeding the 59 level or the 57 level? Well, here you go. Okay, I apologize. This is probability of touching, I should say 56. What? Okay. I found an issue, okay? The issue is me. That should actually say 56. So 56, right? Take a look right there. That says 74%. 74%. So what I want you to think about is you had the stock trading right at 57, right? If you use stops, you set your stop at 56. Your target price to the upside was set at 59, right? So you were risking 1 to be able to make 2. But look at the probability differential here, okay? There's a, 74% chance of getting stopped out. Conversely, there's only a 38% chance of touching the 59 level. Now, this is where, like, if this is the first time you've ever seen this, you know, people look at this and they go, how do you know those probabilities are right? By the way, there are billions of dollars traded in these probabilities every day. The probabilities, okay, they're not just like this mathematical formula. The probabilities are all based on the option pricing. So effectively what I'm saying is the probabilities are accurate. If you did like 100 occurrences or 1,000 occurrences, you're going to find the probabilities are deadly accurate. And that's what's actually scary about trading because most people don't look at this stuff. So I'm going to go forward from here, okay? Because I'm just going to bring it to the next slide, which is just going to take you in detail. Risk versus reward revealed. In the aforementioned Cisco example, the probability of hitting the stop of 50 at 56 was 74%. The probability of hitting the target price, okay, I'm all over with my slides. I'm terrible today, terrible, okay? I apologize. The probability of hitting the target price, and again, what was the target price in there? All right, it's obviously not the price I have in there. Oh wait, I'm going to fix this. That should be a 5 right there. Done. Target price, of course, 59 was 38%. The risk one to make 2 scenario is a setup for a low probability disaster. And that's the aspect that a lot of people don't recognize. And again, I want to go back and just, knock that back to the next slide and over here. And again, you're looking at the probability, like what's the probability, of going up or down? Again, in this example, it's the same thing, all right? The probability of hitting the stop is drastically higher than hitting the target price. What you need to think about, okay, is positioning your portfolio with the right trade logic. Let's get down and dirty. How do you position yourself most effectively without exposing yourself to drastic risks and or a low probability? Because again, what we just learned, all right, is that again, risking that dollar, and I'm going to take you back through an example here again, okay? Risking that dollar to be able to make 2. In essence, there was a much higher probability of hitting the stop versus hitting, okay, our target. So the idea is we need to, number 1, overcome the high probability of being stopped out. We got to stop that garbage. Number 2, I want to define my risk. But I want to define my risk without the use of a stop order. Number 3, I want a high probability of success. A higher probability than this garbage, because if I'm risking 1 to be able to make 2, then higher probability of getting stopped out. Number 4, limiting the overall capital exposure, meaning that I don't want to go out and have to buy, okay, a $57 stock. All right. So defining your risk is one thing, but buying a $57 stock, forget that. Okay. I want to limit my capital exposure, which is number 5. Never need to buy or sell the stock. And in effect, to do that, we're going to go out and we're actually going to employ the use of some options. Now here, this is where we are actually going to talk about options. So, hey, listen, okay, enter the InOut spread. InOut spreads, they're designed to limit exposure, maximize potential with minimal movement in the underlying. So all we want to do, okay, get in, get out, get on with your life. Just say it. Get in, get out, get on with your life. Minimal movement, InOut spreads. Yeah, they're option trades. Please, fear not. I mean, it's 2019 and people are still like, I get scared when he talks about options. I do not care in this room if you're 18 years old and have never traded before, or if you're 82 years old and you're like, I don't have time to learn options. You're 82. It's okay. You can learn them. It's good. Fear not the options. Option spreads are going to allow us to limit the risks without the use of stop orders, yet still while providing considerable upside potential. Ready? Let's actually get to some InOut spreads explained. You guys give me a stock. Anybody? Give me a stock, okay? What stock are you thinking? Come on. We use anybody's stock, all right? I love it. So a couple of people said you should use the stock. All right, I'm selecting my own stock then apparently. So for years I've always used an example, and my favorite example to use is stock. We'll use my stock, and then we'll go into a real stock. Okay, we'll use my synthetic example, and then we'll go to a real one. Let's go to stock. And then stock, we're going to say is trading, let's say at $200, because everything is $200 these days. So, by the way, stock could be Apple. I'll go to some. I have like 5-10 real examples set up for you. Everybody came in there and said Apple, Facebook, okay, and Tesla. Anyway, I can't do it, people. I can't. All right. Oh, Snapchat. Oh, please. I can only get bearish in Snapchat. I'm just being honest with you. All right. Anyway, let's do this stock, and stock is trading at 200. The first rule of thumb here. Are we going to buy the stock? No! I do not own the stock. I don't want to own the stock. I don't even want to think about owning the stock. We're going to use what's termed, again, an in-out spread. In-out spread. Say it with me. In-out spread. You're like, what? What does that mean? Well, if right here is the stock trading at 200, okay, we're going to go out there and we're going to do what's called, we're going to get bullish on this one. We're going to buy a call. Now, again, the very first example I'm going to do is going to be a bullish example. Now, bullish means I want the stock to go where? Up. We're going to buy a call. In this particular case, I'm going to buy, okay, what is termed a 1, okay, 90. You know what? I'm actually going to make these dollar strikes, which is fine. A 199 call. A 199 call. You're like, oh, dollar strikes. For those of you that are experienced, you would see this in the spiders and the IWM and the Qs. I'm just going to make this so easy. I want to buy a call. That call, okay, is going to cost me something. I'm going to buy that call, and that call is going to cost me, let's say in this case, okay, we're going to put the price of that call right at $2, right? And that call is good for precisely 1 month. Now, I bought a call. What call did I buy? The 199 call. What does the 199 call give me the right to do? Okay, options, just about rights. Okay, rights, obligations. I'm going to buy a call. That gives me the right to buy the stock at 199. What do I have to pay for the right? $2. $2, $2, $2, $2. So if I buy this call for $2, what's the most I could possibly lose on that call? I could lose $2, but I have 1 month in which to do so, right? So if I buy a call, which gives me the right to buy the stock at 199, where do I want the stock to go? Okay, where do I want the stock to go? I want the stock to go up. I want the stock to go to 300. I want the stock to go to 250. Please go up. Now, this is what we actually term. It's an in-the-money call. All right, it's an in-the-money call. So I'm going to buy that call on the 199. Any questions about the 199 call? Other than I have to pay $2. What happens, though, if the stock stays flat? If the stock stays flat at 200, I'm going to lose $1. I don't like that, right? What happens if the stock goes down? Oh, no, the stock goes down. I'm going to lose my $2. So what I'm going to do, though, is I'm going to simultaneously, okay, I'm going to turn around and I'm going to sell, all right, a call. I'm going to sell a call. Which call I'm going to sell? In this case, the 201, okay? I'm going to sell a 201 call. And that 201 call, when I sell something, I'm going to collect money. How much am I going to collect? In this case, I'm going to make it precisely $1. Make it precisely $1. Okay, that one's also good for 1 month of time. So let's take these down below. And I'm going to talk about selling that call because that's where people get really confused. So we're buying the 199 call and we're selling, okay, the 201 call. The reason they actually call this what's termed an in-out spread, it's 1 strike in the money, 1 strike out of the money. Now, buying this, it's going to cost me $2. Selling this, I collect $1. Now let's go back for a second. I buy this little guy, all right? I sell this little guy. Net, what am I into this trade for? A $1, okay, debit. Now, stop right there. How can you sell a call you've never owned? You're like, but Don, I never owned the 201 call. You don't have to own it. You're selling yourself into an obligation. You see, option buyers have rights. You have the right to buy the stock from somebody else at 199. If you buy a call, no matter what, you could buy the stock at 199 at any point between now and expiration. But here's the funny thing about options. Nobody wants to ever buy the stock at 199. They go, then why do you buy the 199 call? Because they want the right to buy the stock at 199. Whenever you buy a 199 call, you want that stock to go to clear up to 300 because you have the right to buy the stock at 199. Everybody else has to pay what? $300 for it. So what could you do? You could go out buy the stock at $199 to sell it at $300. But that's okay. You don't have to do that because the thing is going to be trading for what? $101 anyway. All right? So how do you sell a call that you've never owned? You're selling yourself into an obligation. An obligation to do what? To give somebody your stock at what price? $201. You go, wait, whoa, cowboy. I don't even own the stock. You don't have to own the stock. You have the right to buy the stock at $199. Okay? You've sold somebody else to take your stock at 201. I know there's a lot going on in the slide, but think about it. If you have the right to buy the stock at 199, okay, and then somebody has the right to take stock from you at 201, what's the most you can possibly make? The most you can possibly make is the difference between the spread, which is what? $2, $2, $2, $2. You can only make $2 in this strategy. You go, why would I want to do that? I'm limiting what I can make. Yeah, you're limiting what you can make. But oh my gosh, you have 1 month, okay? 1 month in this strategy. And in 1 month, the stock can do a lot. And this thing has a really, really high probability of success in it. You're like, how does it have a high probability of success? Let me show you. You know, some people don't like debit spreads, okay? Do not ever let anybody ever tell you that a credit spread is better than a debit spread, because they have no idea what the hell they're talking about. And I am so adamant about that, right? 21 years in the options business, people go, credit spreads are better than debit spreads. They don't know what they're talking about. The debit spread and the credit spread are identical in every way, shape, or form. In this strategy, you want to pay $1, and I'm going to show you why. If you go out there, okay, and you risk your $1. You got your $1 at risk. What can happen? Okay, here's the stock at 200. Could the stock go down? Could the stock go down? I'm going to change the color of the pen just so you can actually clearly see this, right? If I buy that stock, can that stock go down? Of course it can. Okay, so I go out, right? I've never actually traded stock before, and I buy a $200 stock. If you buy a $200 stock and the stock cruises all the way down, for instance, to 190, you're out $10. How much are you out in this strategy? If you put this strategy on and this stock goes from 200 and it goes all the way down here to 190, okay? How much money are you out? You can't lose more than $1. You know what's cool about that? Your stop order is built in. You never have to get out of the trade, because what's the worst that's going to happen? You know, you can go to 190, then the stock could turn back around a couple of days later, rally back up. As long as the stock is over 201, okay, you're gold, Jerry, gold. You're going to make your money on the strategy. You think about that for a second, okay? This is real. These strategies are implemented every single day, and I'm going to take you through example of this strategy, right? I'm telling you right now, this is the kind of stuff you need to do. This is the kind of stuff not just you want to do, you need to do this. You think about this from a probability standpoint. I'm going to totally blank the screen for a second. Okay, once this strategy is on, here's where the stock currently is at 200. Okay, there's your spread. The stock can go down. It can go crashing down. You never get stopped out. You can't get stopped out. You only have $1 of risk in the thing anyway on your spread. So the stock can go down and you're like, oh, this is going to hurt, until the stock rallies back up. Basically, you're on the clock for 1 month. But should I do it for a month? I could also do this strategy 2 months out. You know what the irony is? It will not cost more to do 2 months out. It will not cost more to do 3 months out. Why? Because it's an in-out. It offsets time decay. Okay? This thing is very well thought out. It's almost like we've looked at 7 million accounts to derive what works and what doesn't. In fact, that's precisely what we did. In-out spreads. Here's a Cisco example. Let's go back and let's kind of continue our Cisco example. However, we're going to use an in-out spread rather than stock and stop orders. Rather than buying a stock at 57, we'll use a spread to limit, okay, that trade, limit the risks, and provide a high probability without the use of any stop orders in here, right? Let's do it. Here we go. This is the exact same slide that we just showed you a moment ago, but now we've actually put real context to it. What's the context? Well, the context is this is now real numbers. In fact, you're going to see the strategy here in a second. So Cisco is trading right at $57. That was yesterday. It's okay. It's moving around a little bit today. We buy the 56 call. Okay. We sell the 58 call, just like the example. How wide is that spread? Come on, tell me. All right. So buy one, sell the other. I apologize. I'm terrible with my slides today. Terrible, I tell you. So you're buying the 56, selling the 58, buying the 56, selling the 58, right? What's the distance? Okay. What's the distance of that particular spread? What's the distance of the spread? Anybody, everybody, anybody. Okay. You got to get this, because this is what's important. Okay. This is what's important, is that you just understand that logic for a moment, okay? That in this spread, well, what's the most you can make? Most you can make is $2. Now, you're paying $1.50 for the 56s, okay? Then you're selling the 58s for a 50-cent credit. It's a $1 debit. Now, what can happen to you? Once you're in this trade, what can kind of happen to you? Well, here's the stock. There's the stock right now. Now, we don't own the stock. The stock could go down. The stock could rally back up. All I need is that stock. Just get above, a little bit above 58 and do it anytime, for example, in the next month, in the next 2 months, or maybe even as far out as the next 3 months, because a strategy like this will not cost you more the farther you go out in time. Let's look at this for real. Let's actually take this. And when I say look at it for real, when I say for real, I mean for real. Because here, this is the strategy. This is the strategy on the trading application. You can see all the different prices. And I rounded some stuff a moment ago. But over here, yeah, this one's not rounded. Okay? This one's not rounded. This one is dead on. There's the stock. Yesterday, stock's trading at 57. Buying a 56 call. Look. I put it as $1.50 a moment ago on your slide. It's $1.48. Then I'm selling these 58s against it. Okay. For the most part, that strategy, buy these for $1.48, sell these for 48 cents. It's a $1 debit. It's a $1 debit. That's your maximum risk is $1. So what do I want to have happen? Now, I could do this thing. Look, I did this one 18 days out. Why? Maybe I want to make it. By the way, you don't have to wait 18 days. You're like, in options, do I have to wait the 18 days to make my money? No. Okay, we actually can show you precisely when to get in this, precisely when to get out. But I wanted to make a point. I did this one a little shorter term because can Cisco move up or down a buck? Can it move up or down a buck in like a day? Absolutely, unequivocally, yes. And it did today, right? It actually moved down, but it doesn't matter. You know, that's the funny irony about this. This stock today, I took the screenshot yesterday. Today, the stock moved down $1. You're like, oh, you're wrong. You're wrong, Don. The stock moved down. What did I tell you earlier? This isn't about direction. This isn't about being right or wrong. This is about putting on the right strategy. A strategy that only has $1 at risk, right? A strategy that keeps me intact. You have to understand something. In-out spreads give you the power to trade massive stocks and index products with a couple of pennies at risk. What do I mean? Hey, earlier somebody was like, well, I wanted to see something in Amazon. I wanted to see something. Amazon's a big stock. Google, monster. Okay? I mean, you're trading like a Google and Amazon, a Priceline. I got one even bigger than that. How about the SPX? The mother of all products. Yeah, I just cut to the chase over here. I went right to the SPX. Why did I go to the SPX? Because it's the mother of all products. I figure, listen, you don't even have to know what the SPX is. Okay? Because there's people that are new tonight that don't know what the SPX is. I'm going to tell you exactly what it is. Think of it as a $2,952 stock. Now, that should make you kind of quiver a little bit. You're like, ooh, I don't like it. Here's 32 days out. A screenshot was taken yesterday. The SPX is nowhere near 29.52 anymore. I like this. I did the screenshot yesterday. Okay, this is not a bullish one. This, okay, this is a bear. Dun dun dun. This is actually a put spread. Buying the 29.55s, selling the 29.50s. The strategy was put on for a $2 debit. Now, this is the 29.55s, the 29.50s. This is not a $2 wide spread. How wide's this spread? This spread's $5 wide. $5 wide spread I can pay $2 for. Okay? What's the most I can make? I can make $5, of which I paid $2 up front. But I want you to think again. You're like, okay, so what's the edge in here? The edge in here is this. Okay, what can the market do in the next 32 days? It can rip higher. It can sell off big. It can rip higher. It can sell off big. Anytime in the next 32 days, I just need to make a couple of bucks, get in, get out, get on with my life. That's the whole ideal of the strategy. Max risk of 205. Okay, maybe I'm dead wrong. Maybe the market goes straight up. I'll lose my 205, but I'll tell you something. In the next 32 days, the market could go straight up. I need one big down day. That's it. I just need one big down day. The irony was today, we got it. We got a big down day today. This strategy is profitable. Go look at it. Next, these are live in-out trade examples. This is kind of where the rubber meets the road. I went back and I took my own account and I only showed you very recent trades. And people are like, well, how recent is recent? Here is an in-out strategy, and I'm showing you the exact returns. I'm showing you everything. Okay, there's no, we kind of are the full Monty over here at TheoTrade, and it's important because again, it's where the rubber meets the road. That's what everything's about. Listen, this is an Intel spread. This is the exact date and time put on, the exact date and time taken off. I wanted something recent. That's recent. It's within 5 days. Here's one where I paid 92 cents. I closed it for $1.55. It's a 68% return. This is a bullish spread. I could lose no more than 92 cents at any given point in time in the strategy. Listen to me. This is not about hitting the ball and hitting the cover off the ball. This is about hitting singles and doubles. This is about consistency. This is a bullish strategy. Again, the bullish, people are like, how did you decide to get bullish? We actually can show you that, but for the most part, the stock was going down. I figured sooner or later it might go up. No, I'm just kidding. I actually had a scan built for this one, but it's straightforward. 68% return. Let's move on. The next one. The next one is actually a bearish trade that I did in the XLF. Now this one is very cute because it had a very, very short amount of time. It has 163% return. This one was actually done, okay, on May 22nd. It was actually closed on May 24th. The interesting thing was it was designed as only a 2 to 3 day strategy. These are May 24th options, right? The max risk in the trade was 11 cents. And you're like, holy smoke. That's crazy, man. That's only a 50-cent wide spread. Yeah, but I turned 11 cents into 29 cents. Is that still viable? Forget about, people are like, what about commissions? Okay. We have a discount on commissions. We have a major discount on commissions. TD Ameritrade, E-Trade. All right. If you have accounts with them, that's fine. We have a discount on commissions. We can't publicly tell you what the discount is, but we have a discount on the commissions to help to do things exactly like this. Commissions, they always have an impact. Okay. But you could turn 11 cents into 29 cents, right? Again, in a 2-day window, it's a good return. And I wanted to bring this one up because this one, it's big return on such minimal amounts of risk. This one actually had a fairly high probability associated with it. Next one on this docket, okay, MA, it's MasterCard. Somebody actually mentioned that earlier. Like, I want to do a trade on MasterCard. Again, these are the most recent trades that I could find. I'm very, about like, if I'm going to show trades, I'm only going to show trades that I've done, okay, within the last month or two. And by the way, there's a ton of trades that I have on right now. Like, could I show even more recent trades? Yes, but they haven't been closed yet. I don't know how they're all going to work out. This is a MasterCard spread, 62% return. All right. It was actually put on. This was an interesting one because it was put on May 31st. The stock dipped. This is a put spread. The stock dipped and dipped hard. Literally, $1.08 debit made $1.73. So we're out. Okay. And for $1.73 credit on the way out. And again, this trade had an expiration of July 5th. So when I put it on in May. It had an expiration of July 5th. We didn't hold it to July 5th. We only held it to June 3rd. I told you, anytime the stock starts to oscillate. Got lucky with this one. And sometimes you do. Stock dipped right after I put it on. As soon as the stock dipped, I'm like, that's it. I'm out of the contest. Next, one of our examples that we've been using a lot today, Cisco. Cisco, this is kind of a slow moving animal. Well, this one was a slow moving animal that literally we put on one day, took it off the next day. Why? Once again, the stock dips, $2 wide spread. These are put spreads. This was a bearish strategy. Okay, it was a bearish strategy. Again, how recent is that? Yeah, within 2 weeks. So that was June 11th. Here's June 12th. We exited. It's only a 31% to return, but I'll tell you what, that surely beats the sharp stick in the eye. That ain't bad. Last, but definitely not least, EEM. That is the emerging markets. This is a 37% return. The 37% return was also achieved in a very, very similar time frame. Put on, again, June 11th, taken off, okay, June 14th. Here's the interesting irony. The month of June has been, a staggering rally. Yet you just saw multiple bearish strategies, and they worked. Multiple bearish strategies. Look at that. That's a put spread. Cisco's rallied. I was bearish. I made money. Okay? MasterCard has rallied. Well, this was a bearish strategy. I made money. XLF has rallied. This was a bearish trade. I made money. Why? I ain't got to be right. I only have to be right one day. This strategy is not about being right or wrong. It's about the right trade logic. Okay? Here's the characteristics of InOut spreads. The attributes of this trade, they're undeniable. You never have to buy the stock. You have defined risk. The risk is limited to precisely your comfort level. You don't use a stop order. Okay, you can vary the time frames and not pay more. Right? The probability of hitting the profit point is extremely high. It's a perfect spread to reduce risk of a stock portfolio because you don't have to trade the stock. You can do it in a retirement account. It's also a great tool for those trying to build returns in a smaller account. Okay? Standing between you and this, you got to build this. You got to build the strategy. Do not let options intimidate you. Okay? Listen, this is the SPX. It's the mother of all products, right? Pennies at risk. Look at it. It's a 205 debit. 205 debit. But a spread like this, you got to look at this spread. It's akin to a power saw, right? I use this analogy a lot, but if you wanted to go out and you want to build a house, what do? Use a handsaw or do you use a power saw? I mean, cutting every single 2x4 and for a house is going to take you with a handsaw about 100 years. But if you use a power saw, it's quick, it's clean, it's the most effective way to get where you want to go. Problem is with the power saw, if you don't know how to use it, you're going to lop off a couple of fingers. And the options are the exact same thing. We can show you how to use this thing correctly, and they're going to be extremely effective in creating returns. Use it incorrectly, you're going to cut off a couple of fingers. This, okay, is all about trade logic. That's what you have to understand. Now, most people, they're not willing to put forth the effort. Okay? The following course material that we're talking about, it could be a little bit demanding to learn. It's not for everybody. If this is not a chart pattern with a following the bouncing ball, I know everybody seems to want that too. Okay? Today's day and age, everybody goes, can I just turn on the computer and let the thing make money for me? No, you're actually going to have to learn something. Okay? If you want to be involved in this business, listen, I don't know what business you're in. Okay? But please, if you're going to get into this business, the business I've been in for 21 years, you better learn something. Because in any business, there's going to be a little bit of a learning curve. You got to really willing to put forth some effort. This is not instant coffee, instant tea. The only way you're going to have a degree of success in this business is going to be based on statistical data. It's going to be based on a logical entry and exit to the strategy. That is what is incredibly important about this. If you think you're going to, again, turn on like red and green flashing arrows, it's going to make me money. It's the secret squirrel system. It doesn't exist, right? You actually got to learn something. Don't fear the learning process, okay? Maybe you have limited options, experience. Maybe you don't know anything about trading at all. Do not let this stuff intimidate you. And I'm going to tell you something right now. If you were to give me, all right, this was 45 minutes tonight. If you were to give us maybe 3 hours, okay, imagine what we could actually take you through. All right? You need these strategies for the foreseeable future. You realize what you're involved in right now in this market? Do you have any idea? Okay? The Fed could literally cough and the markets could tank 200 points. It's insane. Okay? You're one tweet away. You're one tweet away from being completely wiped out in your brokerage account. You don't think that's real? Okay? Why don't you look back over the last 6 weeks? And any one of you that has traded over the last 6 weeks know precisely what I'm talking about. You're one tweet away from being completely wiped out. Do not let it do it. Just use these spreads. That's why I'm so adamant about this right now. We could show you how and when to place the InOut spreads. It's a matter of a couple of hours. What we really do here at TheoTrade is we create highly detailed recipes, okay, for every strategy, including, of course, InOut spreads. You don't bake a cake without a recipe, at least the first time through, right? It's a pre-flight checklist, and that's what we do here at TheoTrade. We actually build you a checklist to go through and say, how do I put the strategy on? Step 1, step 2, okay? Why would you trade without some type of methodology, a strategy, and literally a checklist, okay? This is what you need to know to successfully enter and exit InOut spreads. First, what makes a viable InOut spread candidate? Somebody was actually mentioning a stock a little earlier. Okay, I'll just throw it out there. It was Tilray, and I'm like, oh yeah, you could do that, but But you know, the liquidity won't fit for this. It won't. Okay? It's that is not going to be a candidate. I just listen, you're like, well, I don't like you. That's okay. Okay? That's okay. You don't have to like me, but you do have to follow viable criteria in here. You have to have methodology. So you need to know what makes a viable candidate. Okay? What volatility should I seek out? Somebody in here was just asking that a second ago. Should it be high volatility? No. Too high a volatility. Okay? Trade's not going to make any money. All right? Believe me, liquidity, volatility, it all matters. By the way, yes, you could do this in an IRA account. Everybody asks that. I trade in my IRA account now. I'm at the point in my life where I trade my IRA. So what volatility should I seek out? What options expiration do I select? What should be the delta of the option I buy? What should be the delta of the option I sell? Which option do I sell against it? Okay? How do I build the trade? Like physically, how do you build it? You're like, I don't know. Okay? You know, what's the right amount of risk for me? And again, a lot of people, they have some experience. You have enough experience probably to get yourself in trouble. You know, the variables that I'm going through, what's the right amount of risk? And, you know, how do I build the trade? And, you know, which options do I buy? Which options do I sell? What should be the volatility? Do you realize that if you go at this alone, okay, how much money it might cost you trying to figure this out? Because that's what we do here at TheoTrade. It's criteria. It's a pre-flight checklist. And then once we get you into the trade, we get you out of the trade with every single variable. Trading, it's all about answering what ifs. It's a good stock ETF candidate. We'll give you that. What's the correct options expiration? How much capital do I commit? What strike price options do you sell and how many? Which options do I buy? We have the answers. We build these recipes, definitive criteria and checklists for every strategy and each unique variable. Every variable. What are you talking about with variable? What can a stock do? It can go up, it can go down, it can stay flat, right? We'll give you the right probability. How many option contracts? When do I close my in-out spread? What if the stock sells off big? What's the correct return for the strategy? What if the stock rallies massively? Can I fix a losing trade? It's the how, it's the when, it's the why, it's at what price. That's just the beginning, though. It's just the beginning, okay? Think about a chessboard, right? And there's all these moves your opponent can make. We literally sit down and figure out every single variable that can happen to an in-out spread. We put it together in criteria, let you loose with it. That's what a checklist is. The secret, it's in the sauce. Now, people, you could read about this. Right? Read about spreads like, you're going to Google in-out spreads, you read about them. Reading about a spread means nothing. It's all about the corresponding criteria. It's all about that detail. We spent years, 7 million accounts and years fine-tuning the trade setup, fine-tuning the criteria, fine-tuning the approach. And when you do go in here and you start to place in-out spreads, you better follow the steps to build a trade. Okay? You want the criteria for the in-out spread? In-out spread course curriculum. This is a course. The course is about 3.5 hours. This is what it breaks down to. You're going to learn to construct in-out spreads. You're going to see why these things are being used by professional traders, okay, to mitigate risk for consistent returns. You're going to learn how duration, okay, will not cost you more. You're going to learn how to define your risk with a viable reward, okay? In-out spreads could be used in any market condition or direction. If things get wild and crazy, again, we're one tweet away, okay, from markets exploding higher or selling off huge. And we're going to walk you through how to build your own step by step, literally entry and exit. They are easily managed trades. They're completely set and forget. For those of you that know what a set and forget order type is, it's a good till canceled. We're going to teach you how to walk into this strategy. You do not have to have more than $2,000 initially in your account. That question comes up. This trade can be done in retirement accounts. If you have no options experience, we can help you get options experience with brokerage firms. So people always ask that question, like, I don't have options approval. We'll get it for you, okay? If you're looking for small account, large upside potential. High probability in-out spreads. I am the trade instructor. Again, the course is just over 3 hours. This course, this one, it's so important. It's available immediately. It's 24/7 access. Now, not only is the course available immediately, you also have access to this course off of Theo Mobile. Now, the class slide deck that has all the entry and exit criteria, it's available immediately for download. By the way, there's a question that came in here about Theo Mobile. Theo Mobile, you can even be up at a plane 30,000 feet, have downloaded the course, and you could actually watch it there. But the way this does absolutely work for options on futures, the class qualifies you for reduced commissions rate. You do have to take the course to qualify for the reduced commission rate. The course itself is $199. Stick with me for a minute. Of course, we have a little bit of a special because everybody that comes here tonight, all right? And again, we have almost 1,000 people on. How many of you have ever been to, other webcasts and so forth? Because I feel like every single time people come out to this, you've been there, you've done that. Again, many of you tuning in, a lot of you guys have been through the gauntlet of paid classes. You've bought indicators, these secret squirrel black boxes, maybe a couple other things, only to find, just buy this one last thing. It's going to make all the difference. But wait, there's more. TheoTrade, okay? We're different. Now, if you haven't noticed that listening tonight, we're a little different. Rule number one here, we've had enough of educational garbage. We don't really like sales pitches, and we're going to put an end to it. We like to disrupt financial education. So I want you to remember one thing. First of all, everybody on this team has a minimum of 15 years of experience. There's no professional salespeople. In fact, no one at TheoTrade, okay, ever worked in any sales related to anything financial. All of them have been traders. If you look at the history of Jeff Bierman at TD Ameritrade, guy was chief market technician. Brandon actually wrote the course manuals for the education at TD Ameritrade. It just goes on. Corey's just been an educator for years. Phenomenal crew over there. Educating you, it's our only goal, and we're going to demonstrate that. Hopefully we change the way that you view financial education. We introduced to you, it's TotalTheo. It's unlimited streaming. It's a monthly membership. Okay? Let me explain a little bit about it. The first thing I like to tell you before I even show you anything, imagine that you had a Netflix for traders. Imagine you had a Netflix for traders. That any genre of trading, okay, any genre of trading that you can think of will cover. Any genre. You're like, I'm a swing trader. Good. We have an entire course curriculum of that. You're like, I'm a market technician. Good. We have an entire course curriculum for that. You want to get crazy on me? Think of an option strategy because I guarantee we have courses on it. Every one of them has detailed criteria. You want trading psychology? We got it. You want pairs trading? We have it. You name anything, okay? We are giving it to you. It is access to over 83. There are now 83 trading classes. Everything is available immediately, okay? And on TheoTrade Mobile. We have a full mobile application. Yes, it's for Android. Yes, it's for Apple. This includes high probability trading, how to collect income in being short, the next big short, infinity spreads, guide to selling high probability spreads, iron condors, selling premium, minimize your risk, survive and thrive, day trading NASDAQ futures, covered calls, essential skills for consistency in trading, top 10 skills for growing a small account, pairs trading. This is just a few of them. There's 83 courses in the library. Easily, it's worth over $5,000 just in the classes alone. You're given access to it today, immediately, right now. Go through any course you want. Right now, you can click on them, okay? Additionally, we give you access to 59 proprietary indicators. I bolded auto expected move. Auto expected move is the single most complicated indicator ever written in the history of thinkorswim. I can say that. Why? Because I worked there for the better part of 15 years, right? That thing is unbelievable. That one indicator alone, it's worth $1,000. We have gravity points, RSI Laguerre, Quantix, NQ levels from Tony Rago, next generation squeeze. We have complex position tracker, IV versus IV percentile. We have a Theo Quant setup, unusual options activity. There are a ton of indicators, over $1,800 in indicators and scans. I'm not done yet. We have coaching, live trading, and emailed trade ideas. Oh, and we give you unlimited email support. We have a live trading chat room. We broadcast live 6 hours a day. Most days are even longer than that. Like tomorrow we broadcast for about 7 hours. All of our traders provide real-time trade ideas and real-time market insights. I kick off pretty much every trading session. I like it in the morning. I like to be on at like 6:30. I'm on Pacific time right now. We email out trade ideas. Okay, we'll highlight InOut spreads, infinity spreads. Those have been the two strategies that are viable right now. There are 4 distinct trading portfolios. Okay, we have a daily coaching session. What's a coaching session? It's like a mini class every single day. And a lot of people are like, I can't watch 6 hours a day. I get it. Everything's archived. Okay? Relax. Everything's archived. You don't have to tune in. You're going to get emailed trades. And if you know what? You don't even have to do that. You could actually watch a recorded session just later in the night. Maybe just watch this on a Saturday or Sunday. Okay? And every month, we're still producing new classes. Every single month. It's access to $2,000 of support, trades, and insights. Again, we'll answer your emails. All of it, it's $99 a month. That's it. That's it. High probability in-out spreads course is included in this. Access to over 83 trading classes. New monthly classes, live trading chat room. You realize that a live trading chat room, there's a lot of places that'll charge you $200-300 a month just for their live room. Okay, that's included here. The classes are included here. How could you have no classes and have a chat room? You have to give everybody everything, indicators and email trade ideas. And again, there's email support. It's TheoTrade.com/all. TheoTrade.com/all. Again, you know why it's TheoTrade.com/all? Because it's everything you're ever going to need. If there's something you need to be involved in this business, we're giving it to you. What our members are saying. I love this one. You guys are rocking it. Very impressed. It's really refreshing to have you guys putting this together and sharing knowledge and not upselling everything and turning and burning your customer base. You've got a customer for life because of this approach. And I'm sure I'm not the only one. This is actually one that just came in. Like, it couldn't be any more fresh. It was yesterday at 2:52 p.m. Don is the most knowledgeable person I've ever heard in my 50 years of stock investing, and I've listened to many. His knowledge of how the markets work sitting next to a finance PhD. I grew up around trading. Highly recommend learning what he has to say. Very impressed with TheoTrade. Study under different stock coaches, various intellects and different trading plans. Have not come across anything as good as what I'm seeing here. The people at TheoTrade are very helpful, extremely knowledgeable. I'm looking forward this association for years to come. People, you got to realize what we're doing here. It's as if we're going to give you $100. Why? If you want, right now, you can sign up for just high probability in-out spreads. We'll charge you $199. Or get everything. It's $99 per month. By the way, there's already questions coming in. You're like, per month? Okay, this is not an introductory fee. Okay, we don't do that. It's $99 this month. If you want to continue next month, you can continue next month. It's $99. You go, what about month number 3? Oh, it's $99. We don't do like, buy one, get one. Forget that. It's $99 a month. Cancel anytime. That's it. Okay, we're not tying you in for any period of time. You want to do it? Do it. But I'm going to tell you right now, you're going to find TheoTrade, okay, shocking what is in this archive. In fact, I'm going to show it to you right now. Then I'm going to answer a couple of questions in here. First of all, welcome to TheoTrade. This is what TheoTrade looks like. This is the members' home. Okay. First of all, how to use the site. We have an entire video on how to use the site. We have searchable archive. You can search our archives. What does that mean? You name a topic in here. You name a topic. Look, it's already pulling up. All right, I want to learn about selling puts. Hit search. You just want to learn about selling puts. Hit search. We have created our own little Google inside of this thing. All right, coaching session. Okay, selling puts to acquire long stock. All right, selling calls and puts, chart setups for it. Okay, it just goes on and on and on and on. Next, this is the member chat room. This is actually where we broadcast. Okay, up here, Tony apparently is talking in here. He's talking right now. That's 6:10. It's 6:10. So these guys never stop. You can actually chat in at any time you want, right? So that's what the TheoTrade chat room. This would be broadcasting my screen live. All right, moving on from there. Next, start here. Start here. You're brand new. You've never had any experience. What do? Guess what? It's a start here menu. Options 101, options 201, options 301. Okay? It's literally set up like a college curriculum. If I did not mention this, one of our instructors, Jeffrey Bierman, is a college professor, right? He actually works with TheoTrade on the side, works at Loyola in Chicago, okay, and moonlights back and forth. So we're very, very familiar with how to set up a curriculum thanks to the professor, Jeff Bierman. So that's the start here menu. Next over here, classes. You want to see what the classes look like? You want classes? We got classes. Option strategies, option newbies, technical analysis, day trading classes, trend trading, hedging strategies, futures, stock classes, pairs trading, mindset, Okay, you want to see what this looks like? Unleash the beast. I told you, we are the Netflix for traders. We have broken it already down into genre. You want to learn about iron condors, diagonal spreads, butterflies. Okay, the next big short. By the way, the next big short was such a large hit. I don't mind saying this. We actually had to do the class again, okay, out of sheer demand. InOut spreads, okay, consistent small account growth formula. These are the classes. Any one of these classes is going to be worth hundreds and hundreds of dollars to you. Any one of them, okay? You're only paying $99 a month. With that, this is TotalTheo Unlimited Streaming. The web address is right here. I'm going to pop it up over here. Again, everything that you see today, the mobile application, the email support, all of the courses, the coaching sessions, it's $99 a month. Okay? So do you have questions in here? I'm going to answer them right now. Literally, go in here, TheoTrade.com/all. Enroll now. Okay? Takes about 10 minutes to propagate a password for you. We'll send it to you. We could start chatting there literally tomorrow morning. I'm live at 6:20 Pacific time. Let me answer a few of the questions, okay? Get right to it. By the way, you need to get a hold of us after today, support@theotrade.com. We're also here. We are here. It says we are here. That's because we can answer questions live for you right now. All right, here we go. First, is this a subscription, okay, for $99? Yes, it is a subscription. It's for 1 month. You can cancel anytime. You can opt out. That's fine. Listen, we don't ever want you to opt out. We think that you're going to get in TheoTrade. You're going to like it so much that we never want you to leave. That's, it's part of the idea. In fact, if the first month you guys sign up for $99 and just leave, okay, we don't even break even. Literally, we don't even break even. That's not your problem, but we have almost 4,000 members of TheoTrade. We're doing something right, right? We're doing something right. By the way, I love the next question. What's a fruit fly? That's a mat. That's actually one of the mat strategies. You like that one, okay? So you can opt out of this at any time. Next thing, somebody was actually saying, I can't get approved on options. I can't get approved on options with my brokerage firm. We will help you get approved, okay? We have got an in TD Ameritrade, E-Trade, Tastyworks. Those are 3 major brokerage firms. We actually have market agreements with all 3 major firms, all right? Next thing, all of these trades could be done inside of your IRA. You could do these in your IRA. You could do them, okay? Not a problem whatsoever. If you can't make classes live, everything at TheoTrade is recorded. All 6 hours a day, it's recorded, it's archived, right? If you're Canadian, Terrence, you had a question about Canadian. I will personally handle Canadian brokerage accounts because I've got some strong feelings. Listen, there's not a great answer when you're up in Canada, but I've got some pretty good suggestions, okay? How do you handle your in-out, trades? By the way, I'm constantly trading in-out spreads constantly in the mornings. So just be on the lookout for in-out spreads. I teach you to open them. You'll know how to close the trade yourself. All right. So again, Terrence, that's not who you want to be with. I'll help you though. I promise, man. If you're in Canada, I will help you out. Okay. So if you already have a TD Ameritrade account, we will get you a discount on your account, assuming you don't already have a spectacular discount, but we can get you a discount on there. Not like this one. I could never get my head wrapped around options. Will I be able to follow the class? Well, that's what that Start Here menu is for. Okay. You give us 3-4 hours, we'll teach you options. There's nothing better out there for taking you from like A to B to C. Again, the curriculum in here is what you want to follow. Next question came from David. Is this practical for a larger portfolio margin account? Absolutely. Okay. But David, I actually use a portfolio margin account. On a day-to-day basis, you're going to see me in the IRA because I try to water it down a little bit more and make the strategies applicable for everybody. If you're a portfolio margin account, not going to hedge around this. You're going to be following Matt a lot. Matt is actually not only trading in a portfolio margin account, but Matt is trading with a few $1 million in front of you guys every single day. So we all kind of take our positions. I'll do like in-out spreads and work with accounts anywhere from $2,000 up to about $250,000. Matt typically works $250,000 plus type accounts. So we have got you covered. Ha! George Ross, sorry about that. I said your last name, but do you teach gamma scalping? Oh yeah, of course. Okay. There's actually a whole thing on gamma scalping. So George, we got your back on that one. All right. Chat room is active. Okay. We're only active during market hours, but we also do a Wednesday night happy hour. And then additionally, the classes are typically taught on like Saturday mornings. So it's good stuff. How do I reach the instructors and traders? All right. You just email support@TheoTrade.com. It's right there. Support@TheoTrade.com. Whoever the instructors that you want to reach, put it in the title. We'll get you there. Okay. We do have currency style classes. No problem. How many in-out spreads am I going to do a month? I would say myself, on average, I'm 6 to 8 in-out spreads a month. Easy. 6 to 8 in-out spreads a month. There's going to be times, though, where I will, I'll push the envelope on a different strategy. Depends on market conditions. And I want you guys to know that. Like, I'm going to push the envelope depending upon what's working. Right now, I'm telling you, in-out spreads, that is what's working. In a Twitter-happy world, you got to do this. All right? I'm telling you got to do this for your portfolio. You got to do it for yourself. You got to be able to sleep at night knowing that you can only lose X amount. We were talking about portfolio margin and big accounts. The bigger account, I don't care right now. You got to take it easy. You got to take it easy until we know what's going on in the next couple of weeks. We got to get through this, through the Twitter-happy geopolitical risk time. With that, again, I want to thank everybody for joining us tonight. Please, if you have questions, hit us up, support@TheoTrade. I hope to see all of you in the chat room tomorrow. And please, if you're in the chat room tomorrow, come in and say, this is my first day. We will welcome you in there. There's at any given point during the day, there's over 1,000 members now live in there. And you're going to find out it's a great environment. TheoTrade.com/all. Have a wonderful evening, everybody. Bye-bye.